Well, it's a very good morning from him, and it's a very good morning from me. I hope everybody's well. So let's just flick over here and say hello to everybody. Hope you're well. Hope you're good. Welcome to my Monday morning or afternoon mortgage insights into the ideas, techniques, insights, thinking, technical update, CPD, if you like, on everything there is to do with mortgages. And that's what we deliver this for, to help you continue to become a really effective mortgage advisor and maybe beyond into the world of financial services, possibly. But we'll see how that pans out. Hope you had a good weekend. It was really sunny this weekend, wasn't it? And pleasant. With the hours went forward, which was nice. So we got extra daylight and the sun shining this morning. And the England football team did okay. So that's good omens for Germany and the European. We may just actually sneak it this time. You never know. First victory since 1966, but we'll see how that pans out. My rugby team got beaten again on Friday, so we won't talk about that. I think we'll wait till next season to see if Gloucester Rugby do any decent things on the pitch. But enough of the talk of football and rugby, or whatever your sport is, whatever your weekend looked like. Let's get into our topics today, because I want to get straight down to a couple of really big, meaty topics. The first one is I want to catch up with you one of the changes coming through in the new tax year for capital gains tax. So I want to pick up on that, but related to a mortgage advisor's job, not to a financial advisor's job or a theoretical textbook page. And then we're going to take a look at direct debit carnage, as I call it, how to prevent direct debit carnage. That's the plan to help you out this morning as well. Anyway, let's head over to the big whiteboard then for the first topic, which is capital gains tax. So let's pop across here. And as you notice, I've already prepared my title for you. How mortgage advisors can help asset-rich customers via capital gains tax. That's my title, really. And what I want to do is just update you on capital gains tax, but with a relevance to a mortgage advisor. Now, be careful, because capital gains tax is taxation, so we're not qualified to give advice on this sort of thing. But you can still talk about it and then make referrals to accountants, tax advisors, lawyers, financial advisors. There's nothing to stop you doing that. And if you want to give your client a proper service, proper connection, then we really do need to be up to speed with this topic. So now, what's brought about this then? Well, the Chancellor of the Exchequer in the budget has actually announced a increase in capital gains tax, not to the rate, that's staying as it is, but to the annual exemption. And for the tax year 23-24, the annual exemption is going down to £6,000 per person. That means that you can earn that amount of capital gain without incurring capital gains tax. It's been virtually halved, and it's going to be halved again the following year, which means people will pay more capital gains tax. So let's talk about how it affects us as a mortgage advisor. Well, the issue here, of course, is that capital gains tax is paid when you sell an asset. So you need to have somebody who's asset rich. Having an asset, so shares, antique paintings, houses, unit trusts, these are all assets. And when you sell those at a profit, you pay capital gains tax. Now, of course, most of our clients, if not all of our clients, have property involved. So let's put a property up here then, because we're talking here about property. It's the purchase and sale of property that could incur a capital gains tax liability. Or that one won't, because it's a bit wonky in there. There's probably a bit of subsidence going on there. Now, of course, the issue here is that when somebody buys a house for their main residence, their principal private residence, then that particular property is exempt. So what we've got here, you see, we've got a landlord, and this landlord, she owns a property over here, which is her family home, let's call it that, shall we, which is her principal private residence. And that's where the kids live, and that's where, the spouse lives and everything, and that's where that's their family. Now, your client over here, so let's put your client in this situation. Let's put her in there. There you go. Your client, little ring of pearls there. She's effectively a landlord, which means that she owns a second property. Now, it's that property that's liable for capital gains tax. That's the point behind it. Now, that property could be rented out to tenants. It could be a holiday let, rented out to holiday makers. It could just be a second home that they use occasionally. They're the ones that cause all the problems, aren't they? Down by the seaside, these homes that are owned by other people, but they never ever use them. Anyway, enough of that politics. But this capital gains tax, possibly. So let's look at a number of ways in which this client of yours, the landlord, how she can minimize her capital gains tax, because she's going to have to pay a bit more now because the annual exemption has gone down. Now, first of all, she can think about having two people. If she's on her own, that's fine. But maybe she has a spouse or a partner, civil partner, or somebody who's she's married to. So let's put this guy in here. Yeah, put a little tie on him there to make sure. There you go. Now, that's the spouse. Now, the point is that when you own an asset, if there's two of you and you both own the asset, then you can both get an annual exemption, which is great. If the house is owned jointly, joint tenancy would be on, or tenants in common, doesn't matter. Fact is that the asset's owned jointly, so you've got two amounts of annual exemption. Now, the annual exemption is going right down now, so it doesn't matter so much here, does it? But you could find that maybe she's the higher rate taxpayer, he's a non-taxpayer or low rate taxpayer. She could pass the house over to him, and therefore, because it's spouse, civil partner, therefore there's no issue. He wouldn't end up then paying capital gains tax. That's certainly one to think about. Okay. What else can happen here? Well, when they own the house, they can make improvements to it. So let's put a lovely little dormer here, shall we? Let's put a dormer in there, and then we'll put a little window in there. So they've extended the roof, just like my picture to you. They've extended, or not extended, they've converted the roof attic into a habitable room with a dormer and stairs, etc. Made it an extra 2 bedrooms, and therefore renting it out for more money. Now, that's an improvement to the property. And as long as she keeps records, so there's your records, of the cost of those improvements, she can offset that against the capital gains tax liability. So if it costs, for example, 20 grand, then she can offset 20 grand from the gain that she makes from selling the property later. And that's a particularly useful thing to do. Improvements, yes. Maintenance, no. So if, for example, she does some work around on the windows, she maintains the windows because they've deteriorated, started leaking, then that cost is not alleviable against capital gains tax. That's just something she has to incur. It's only improvements. Logically, an improvement is going to cost you money and it will increase the value. So why should you pay capital gains tax on that? Because you paid to increase the value of the property. Makes sense, doesn't it? Now, the next thing to think about now are the costs of the purchase or sale. Now, we're talking here about reducing the gain, aren't we, before she gets applied capital gains tax. And there's a number of other costs involved in buying and selling the property. So there'll be stamp duty, land tax, there'll be lawyer fees to pay, there'll be valuation costs to pay. There'll be various costs involved in buying and selling that asset. And those costs can also be reduced from the actual gain that you're making. And that's pretty good, isn't it, in its own right? So that's a few things she can do with the property. Now, if she's got her own money, there's nothing to stop you talking about, not advising. So, if, say for example, she's got some of her own money here, yeah, that she wants to invest. There's nothing to stop you talking about the fact that she can invest in assets. Obviously, property is the key one, but she could put that money into something like an ISA. And the ISA, of course, is exempt from capital gains tax. She could invest in a REIT, for example, a real estate investment trust, which is property, within an ISA, and that, of course, would also be exempt from capital gains tax. If she's got some shares that she owns, she could do what's called a bed and ISA. Funny phrase, that, bed and ISA. It used to be called bed and breakfast years ago. For bed and ISA, which means she can transfer the shares effectively into an ISA and not get capital gains tax. Now, be careful with your conversation around this one, because you're not authorized to give advice in this area, but you can chat about it and then make a referral to an IFA or a wealth manager, financial advisor. You should have referral conduits open for that purpose as well. Now, the other thing you can have a chat about before you make a referral is, let's get a different color pen here as well. This property, this tenanted property, is owned by her, for example, and she would eventually sell that and pay capital gains tax. Now, if she decided not to have done that, if she had bought the property through an SPV, so let's put the SPV over here, shall we? SPV. Now, the SPV, I'll put that in a big box there for you, is a special purpose vehicle. This is a limited company that she sets up for the purposes of buying that property. Now, her surname might be Smith, so this might be Smith Properties Limited or something, whatever she wants to call it. But the point is, though, that the property is now owned by the SPV. She buys it through a limited company, which has many advantages, disadvantages, and we talk about that in other videos. But the point is that capital gains tax is a personal thing. Only individuals pay capital gains tax. Companies don't pay capital gains tax. So to avoid capital gains tax, which is getting more expensive, she needs to buy through an SPV. But what happens, of course, is the SPV owns the property and they pay the mortgage, the rent goes into the SPV. She will get her income via dividends or salary. Now, those, of course, are liable to tax in their own right. There's dividend tax to pay, and then there's obviously income tax, national insurance on the salary. So if she wants to make money from this deal, income, then she's going to draw money out of the business into her pocket. She's got to pay dividends and salary. It's just like any limited company. So that's obviously a disadvantage in that respect. Now, if she hasn't even thought about that, then she needs to talk to an accountant. But unless she's been living under a rock, she would have heard about SPVs because they've been all the rage since 2016 when all the taxation changed for landlords. So have a think about that as well. Other ways that she could minimize capital gains tax, well, there's loads, way beyond your conversation, really. I mean, she could gift assets to charity, for example. She could put money in an EIS, an enterprise investment scheme. She could look at some kind of holdover or rollover relief where you're effectively postponing any capital gains tax charge till later. There's opportunities there as well. She could look at lettings relief, maybe renting out one of the rooms or something like that. There's different ways of relieving the capital gains tax, which are well beyond your conversation, really, which is why you need to get her talking to her accountant or tax advisor or specialist wealth manager, something like that would be a help. Tell me, please, that you do have these conduits to make referrals. You should have them. You might want to become one yourself at some point. There's nothing wrong with that. But that's just ways of minimizing capital gains tax, which has hopefully allowed you to understand more taxation. By the way, there is one other way of avoiding capital gains tax, and this is a bit drastic. But what you can do is you can die. There you go. If she dies, there you go. Da, 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 da. If she dies, she owns the house. That forms part of her estate. There's no capital gains tax to pay on death. Not a lot of people know that. Obviously, her property is now forming part of her estate, will get inherited by somebody. So there's going to be some possibly inheritance tax to pay. And whoever inherits the house, for example, capital gains tax liability starts from that point onwards. That's a bit drastic, isn't it? Dying to avoid capital gains tax. Although you probably watched a movie about somebody going off in a canoe, to falsify their death just to get rid of these things. But that's another issue. So that's an update for you as a mortgage advisor on capital gains tax. Hopefully that's brought it to life a bit, really, as opposed to just a textbook of detail that we often get encountered to read, don't we? So hope you enjoyed that. Bye. Alrighty. Okay, so that's a lovely little update there for you on capital gains tax. Now, as you know, of course, the new tax year is starting literally in about a week's time, isn't it? And you might be thinking about your exams, if you're doing any. Do I need to start thinking about the new tax year? Often you don't, because the education people don't change syllabuses until later in the year. So whatever you do, get the tax sheet that's in your exam, and that's the tax figures that you're working on. And you never need to remember them anyway, but we're updating all of our videos over the next month or so that our boot camps for all the CMAPs, protection, equity release are all in the current tax year, because I think that's the right thing to do. So that's coming up in the next few months or so. And we'll probably have a few of them on this live stream as well, just to keep you up to speed. But most of the videos we produce, we put onto the boot camps. If you're interested in those, just let me know. Okay, let's get on to our last topic for you. It's one of my favorite ones, actually, because this kind of has a personal kind of connection with myself, and I'll explain to you why this is the case. But let's head over to another whiteboard, because I don't really want to spend time wiping that one down. So I'm going to use this whiteboard for you, which again, I've already pre-prepared. There you go. How to prevent direct debit carnage, this one. Now, way back in the financial crash, back in 2008, 2009, 10, the mortgage sector, if you were in it, just died. It just and banks just collapsed. There's talk of it happening at the moment. I don't think it's that bad this time, but back then the big boys were nationalized. Nobody was lending any mortgage money. The specialist lenders stopped and just went bankrupt, most of them. The big five banks, Nationwide, I guess, was in there as well, only had limited money to lend, and they were so scared of lending anyway. They were trying to build up their capital, which meant that the mortgage market died a death completely. And my business, as a result, of course, went down as well. And we had lots of costs, young children to pay for, etc. So I often did what I call direct debit research, or a cull of my direct debit. So I went through every expenditure that we had as a business, as a family, and I went through the statements. And if anything on their direct debit I didn't need, or didn't think I'd need, or didn't really know what it was, I would just cancel it. And we call that direct debit carnage. Now, your clients might be doing the same thing, because you advise them on a mortgage, sold them a mortgage, you sold them some protection, some general insurance, home insurance, and maybe some life assurance. You'd have done different companies probably with those. So the direct debits would be called different things. So it might be NatWest, might be the mortgage. It might have been Prudential for the home insurance. It might have been Aviva for the life assurance. So your client will be getting these direct debits out, and we'll go through them, particularly if they've come across some hard times. Now, cost of living, everything's different, of course it is, but you got to think about these things, because people will struggle. And it reminds me of a lovely song from the 1980s. I'll show you the picture of the chap that did the singing on this one. Here's a picture. I don't know if you can pick that one up. The Money's Too Tight to Mention, which is a Simply Red track from 1985. Take a look at the lead singer there. He looks very 80s, doesn't he, with his outfit there. Now, it was a brilliant song. I think it went to number one, not quite sure. But it talked about America in the mid-80s. Somebody had been made unemployed, etc. And this guy wasn't getting unemployment benefit or anything. So it's just to remind you, people will get to the stage where money's too tight to mention, and they will go through the direct debits. Now, what I want to do now is give you seven tips to help you with this if you're carrying out MOTs with your client, which you should be doing. You should be doing it anyway, because it's the right thing to do to keep in touch with existing clients, because they already know you, love you, and trust you, and they'll do business with you if you keep in touch. If you don't, they'll forget you and go on. And besides, things like consumer duty is only cementing the need to do that anyway, because you should be doing it. So 6 ideas. Number 1 for you. Let's grab a pen for you. And this one's about skiing downhill, as I call it. Here we go. Skiing downhill. Depending if you've done ski, I've never skied, but apparently you go downhill when you ski because of gravity. And that's the point here. So what do you want to do when you have your MOT with your client and you're chatting about them, updating them, whatever, just to remind them of the state benefits that are available if they fall upon hard times. So job seekers, welfare benefits, universal credit, get some numbers out, get some figures out, show them what they're going to get if they do fall upon hard times. Now, the point behind that is you're now comparing the state benefits with the benefits that you have given them in your life insurance, income protection, or whatever it is, so that they see like £120 a week from the state, and they see you're able to give them £1,000 a week. You see, it makes them think about, they're actually getting some value for their premium. So I would definitely do that with them when I talk to them. Here's another one which not a lot of mortgage brokers really get, and I understand that because it's done for you. But when it comes to getting commission, what I suggest you do is you go non-indemnity. Now, it's a horrible phrase. You've probably heard of it. Now, non-indemnity versus indemnity is the way that you receive your commission from the insurance company. Now, most of you probably get a lump sum of commission, or your company that you're part of gets the lump sum of commission, and you get a bit of that. And then what happens is if the customer cancels the direct debit within a certain time period, you get that commission clawed back. Because when you do it on an indemnity basis, you're really getting an interest-free loan from the insurance company for the total commission that you will get if the client keeps the policy forever, really. And if the client doesn't, they want their money back. So what we suggest is you think about non-indemnity commission. In other words, getting it each month. So effectively, client pays a premium, you get a tiny percentage of that. Client pays another premium, you get a tiny percentage of that. I know it's not going to fill your coffers, but it means that you're only getting commission for the premiums that are being paid. Now, once you start getting a lot of these, it all adds up. Of course, it does. General insurance is usually paid that way, which is why you have things like trail commissions and ongoing commission that's paid forever. And I know some brokers that have done very well out of general insurance commission only after they've got a critical mass of policies sold. So that's something to think about if you want to preserve your cash flow. It's butter now rather than butter guns later or whatever they call it, don't they? So have a think about that one as well. Now the other thing to think about here, this is point number 3. Let's put this one in red for you. Number 3 is some insurance companies offer a lot of flexibility. So if your client is thinking about the premium costs and it's costing a lot of money, try and think about the flexibility. Maybe the insurance company allows a premium holiday. Some do. Maybe they'll let them off a couple of months of premium if times are really hard, if they've lost their job, for example, and they're trying to get a new job. So maybe 2 or 3 months off the premium might be a useful opportunity. So take a look at the insurance company you're with and see if they offer that, because the insurance companies don't want to lose clients either. So they're not daft. They're working out flexibility as well. On the other one, you can adjust the cover. There you go. Now, this is the one that I did actually. 10, 11, 12 years ago. I was looking through my insurance, as I said to you, and I was paying £175 a month for my income protection. That's a lot of money. But I'm of an age where it costs a bit more than the average. And I looked at that, I can't afford that anymore. I really wanted to cull my expenditure. We had to. Life was like that. So I actually decided to adjust the cover. Now, in my income protection plan, I went from a 3-month deferred to 6-month deferred, and they allowed me to do that. And that cut the premium dramatically. I also cancelled the index linking, which meant that it went up by 5% each year. I stopped that, and that immediately prevented the premium from going up anymore. And I was able to bring the cost down by 40, 50 quid, which made a difference. I kept the policy. I've still got it now. And I reinstated index linking. I had to have another medical, but it meant that I could cover that period of uncertainty, if you like. So have a think about adjusting the cover. Income protection is pretty useful at adjusting the cover along the way. Let's have a look at thinking about doing half-yearly reviews here. Half-yearly reviews is the next topic for you. Now, I've talked about these before. If you're doing a half-yearly review or yearly review, whatever it is, resell the protection is the key here. Talk about the need for protection because the client might have forgotten it. Now, remember, when you do this properly, you don't preach. Nobody wants a smart aleck financial advisor, mortgage advisor telling people what to do. Sorry, you don't. It's not the way the world works. You need to coach. You need to facilitate. So re-coach the client on the implications of dying, getting ill, etc. Just go through the motions again. Just remind them of why they took it out. And that's a useful technique to do. Again, under consumer duty, you're going to have to do these sort of things. If you charge a fee, you're going to have to give fair value for your fee. And it just doesn't happen right there and then. The fees, of course, occur as an ongoing fee. Therefore, you need to give value for that fee as well. When you're conducting your MOT, you use your affordability expertise. And what we do really well is we do good budgeting. We're able to complete budget analysis forms. We're able to do good affordability guidance and chats about income, expenditure, etc. So it's what we're trained to do. So use that technique, that skill, to help the client to deal with if money's too tight to mention. If they really moan about money that's too tight to mention, really go through their income and expenditure and see what they can get rid of without losing any benefits. You're trained to do it. You're an expert in that area. So use that technique as well. The other thing you could do, just to finish things off, do this one in red, is go for classic benefit selling and highlight some of the key benefits they're getting from the policy. Obviously, the money they're getting is a benefit. Of course, it is. Compared to the state benefits, it's much better. But what other benefits do they get? Now, have a look at some of the things that might interest them. Child cover, for example. They might have had some children, so they're getting free child cover under their critical illness, could be one. It could be the income protection gives them holiday benefits, maybe repatriation. They might not need for travel insurance. Some of the high bell whistling things give all sorts of benefits, don't they? Some of these high expensive policies that they're doing. Doctor services, online services, many do that now. GP24, I think it's called. Mental health counselling, some of them give as well as part of the deal. So take a look at some of the other benefits and highlight a few of those that the client may never even thought about. So they think, actually, that's really something we do need. Let's not think about cancelling that. Let's cancel the Netflix or the Sky instead, or the season ticket to Gloucester Rugby, which might be another example that you might choose to do. So there's 7 ideas really that will hopefully help you to prevent direct debit carnage. Remember the song Money's Too Tight to Mention from Simply Red? It was based upon the mid-80s in America. And what was happening there, of course, we had a massive, massive recession. Millions in the States and the UK were struggling with unemployment was a big issue, of course. Now unemployment's not so bad, but people have mostly got jobs, but salaries are much lower per se compared to the 80s. So people are finding it difficult to cope. 40 years later, as I say, it's the same thing. History always repeats itself. So if you ever find that money's too tight to mention for your clients, have a chat with them about things. It might stop direct debit carnage. Hope that's been useful for you. Bye on that one. There you go. Couple of hot topics. So hopefully you've enjoyed them. Important topics too. As a mortgage advisor, we do need to start thinking about the consumer duty. I don't really talk about it much. It's a compliance thing, and there's plenty of people that are talking about consumer duty. But as far as I'm concerned, it's about looking after your customer. It's about, they use the phrase fair outcomes. I think it's an awful phrase, but I think you just need to look after your customer or client, give them the best service you possibly can, give them value for your time and your fees, make sure the client gets excellent support from you. If you can do a net promoter score to measure it, even better. Make sure they're looked after properly, which is the key to the whole process. You should be doing that anyway, and I think it's right that you do that moving forward. Anyway, enough of that. Let's hope you enjoy your week, the rest of your week that's coming up. I don't know what you've got planned. Any exciting things, bit of sunshine this week as well. Of course, we've got a little thing called Easter in 2 weeks' time, and maybe you've got a couple of days off as well for that one. That's something to look forward to as well. We'll be here next week, and we'll be here for another live stream next week for you. So I look forward to seeing you then. Other than that, have fun, everybody. Enjoy your week, and I'll be seeing you all again next week. See you then. Bye.